This is our 5th year of doing this. We started in 2009, and as an exercise, I went back and looked at my slides from our first year, and I was surprised to find out there are only 24 slides. And I looked at this year, so the bad news is it's triple that. So if at any time you start to feel yourself falling asleep or something, the bar's still open, so help yourself. But, you know, lots of things have changed since 2009. When we first started this, we were in a severe economic crisis such as we hadn't seen since the Great Depression. And today we've had several years of great stock market returns. Market has more than doubled since its bottom in 2009. But the economy continues to struggle, as we like to say. And so we want to talk about where we are today in this process and where we think we will be going over the next year or so. So moving forward, as I have each year, we look back and say, all right, what did I say last year and what actually happened? Yet generally they're not the same things, but we'll take a look. So last year, this slide, we thought economic growth would accelerate in the second half of the year. Remember where we were a year ago? We were on the edge of the fiscal cliff, if you remember. We had the sequestration going on and all that, and we didn't know if Congress and the President were going to come together and have some sort of a deal. And we were really in a stall mode for the economy. So we knew the first half was going to be difficult because we had to deal with increased taxes and lower spending at the federal government level. But we did think the second half of the year, the economy would accelerate, and for the full year, we'd have growth around 3%. We thought the 10-year Treasury note would end above 3%, with the long bonds being the worst performing asset class. Housing starts would end the year at an annual rate of 1.3 million units. We'll go through these charts to see where we started the year. There'd be over 3 million new jobs created. And the S&P 500 would return greater than 15%. Now, this is what I had in writing because I thought, well, you know, if we have something in that magnitude, I'd be okay. But what I said then, I kind of whispered it. I really thought it would be greater than 20%. So I don't have that in writing, but I think if we look back on the tape, we might hear it. Okay, so first point, economic growth would be above 3%. If we look at it, these are quarterly numbers. So this was the fourth quarter here of 2012. We basically had no growth. First quarter was 1%. Second quarter, a little over 2%, about 2.4. Third quarter is in at 4.1%. We don't know the fourth quarter yet. We'll know tomorrow at 8:30. So we'll find out. If we happen to come in at 4%, then we'll have had 2 quarters of 4%, a 2%, a 1%. We're pretty close to our 3%. Not quite there, but pretty darn close to the 3%. And looking at it here on a trailing 12 or trailing 4 quarter on a 1 year percent change, you can see right now, again, we're right around 2%. We'll drop off a 0. We'll add a 4 for the average. That'll get us to the it's pretty, as I said, to pretty close to 3% if we come in at 4. Now, 4 is at the high end of expectations. Some of the data that's come in very recently makes us think it's probably going to be around 3%. But still, the second half of the year will have grown about 3.5%. So significant acceleration in the second half of the year for the economy. 10-year Treasury note ends above 3%. You know, it doesn't sound like much, but we really went out on a limb on this one. If you look back, and where we were, down here, we were at the 1.5% area for the 10-year Treasury. I mean, it was very low there. In fact, it was historically low. We started the year at 2%. So a full 1 percentage point rise, and as you know, we ended the year right above 3%. So we hit that one pretty much spot on. Looking back a little longer, because I like to take a look at the last 5 years here, we came out of the recession, and the 10-year Treasury got all the way up to 4%. And then we hit 4% again in 2010. So about a year after the recession ended, we were still around 4%. This is when the Fed really started getting aggressive in the quantitative easing. Rates did fall, but beyond the fact that the Fed was getting aggressive, it also was a point in time when we all recognized that this was no ordinary economic recovery. It was a very soft recovery. We did not have what you typically have early on in the recovery where the economy spikes and makes up some of that lost ground that you have during the recession. And we recognize that the economic growth that we're having, the slow growth we were having was going to be a protracted period of time. That's when the Treasury notes really started, the yields really started to drive down. The reason why the second half has gotten back up to 3% is because there is more hope now that our economy is finally on some sort of self-sustaining mode where growth will beget more growth. And that is truly what the Fed now believes we're in the process of doing and why we've begun the tapering with the quantitative easing. We said long bonds would be the worst performing asset class. We all know stocks up over 30%. The green line here, which is barely above the zero dashed line here. If you're in cash, you earned a good 0.1%. Congratulations. And then bonds down about 6% for the year. Interestingly enough, we've been having some discussions about pension funds in our department. And yesterday, Ford reported their earnings. And they're very proud in their pension fund that they have done a lot to take away volatility in their pension fund, and they're 70% in bonds. Their pension fund returned 3% last year. And the reason why they have 70% in bonds was not because they thought bonds were going to outperform stocks, but what they were trying to do was immunize their pension portfolio from harming their income statement. And this is what has happened with our government. Is they've made so many rules, and it's not just our government, it's GAAP accounting and so forth, that it has made it almost obsolete today for companies to have pension funds because of how difficult the accounting is and what it does to the corporate income statements and their earnings. Unfortunately for Ford, from a point of view of being able to have long-term the greatest amount of assets, they made the wrong decision, being 70% in bonds. But for the corporation, they believe they made the right decision. So it's interesting when we look at long bonds, say who would invest in long bonds? Well, a lot of it is being invested in pension funds, and it's being invested for, in my opinion, for the wrong reasons, not being invested in long bonds because they believe that that's an asset class that is going to outperform other asset classes, but because it immunizes them from accounting changes. Housing starts ending at 1.3 million. We started 2009, coming out of the recession, at 500,000, and we stayed there, or we stayed around 600 million for the first couple years out of the recession. Started to accelerate in 2012. We ended the year around 800 million, a little less than that. We thought it would be a significant rise up to 1.3 million, which would be up here. We got to 1.1 million in November and then December. For various reasons, housing starts came in at an annualized rate of 1 million. So the direction we were correct in, magnitude we were a little bit off. I still believe, and show you the next chart. This is a busy chart, but this goes back to 1960. Right here, you say it's about the median number of homes being built per year is about 1.5 million. We're still way below the average, way below the average. So there's a lot of pent-up demand here. We know this because we know of all the stories about children, and I put that in quotations, in their 30s still living in mom and dad's basement. That's pent-up demand. So housing units, they need to be built, and we'll go through some charts in a little while as far as where we stand with inventories and so forth. S&P 500 turns greater than 15%. So what were our highlights? Well, as we said, economy accelerated in the second half. Stock market had its best year since 1997, and those were those years, those glory years. Government deficit was reduced substantially. We'll go through some more charts on that. European economies began to grow. I mean, they were in a deep recession for much longer than we were. Many of those economies came out of the recession in 2013, and they're having some growth. Again, it's very slow growth. And Abenomics propelled the Japanese stock market to a gain of 57%. And what is Abenomics? Well, basically, the firms in Japan just took a look at what was working in the United States and copied it. I mean, really. I mean, he looked at what Ben Bernanke was doing and said, let's try that. And they did. And we see what happened to the stock market. And it's not just the stock market. The economy in Japan is doing very, very well. So let's look at the current situation, the debt and deficit. This is one scary chart. This is the federal debt. Let's go back again to 1965, where it looks like we had no debt, which isn't quite true, but it looks that way in this chart. We got to 2000 here, and we had about $6 trillion in debt. And then since 2000, it's all the way now up to 17 trillion. And that is scary. When we think of those absolute numbers, that's what everybody talks about. My God, how are we ever going to deal with $17 trillion of debt? Well, the way to look at it is not in absolute numbers, but in relationship numbers. And in relationship, we talk about our overall GDP, how much money is in the economy. And our GDP is about $17 trillion. So right now, we're just slightly, and this is still, unfortunately, this is all government data that I'm getting here. And they're slightly behind. Our fiscal year ended in September of 2013, and they don't have all the data in yet, so I don't have this graph updated through our fiscal year that just ended. So this is still as of September of 2012. And actually, it's been, it's about even to where we were in 2012. Still below where we were at the end of World War II, where we were 120% of GDP, our debt was. That was reduced substantially, as we said, until we got down to the bottom here. And when Ronald Reagan entered office, it was a very small amount, only about 35% of GDP. Grew until the Great Recession occurred, is what we call this. We were at 65%, and now we're over 100%. The good news. The annual deficit as a percent of GDP is starting to improve. It's still, down here, it was as large as it's been since World War II, when there were tremendous deficits to fund the war cause. But what you see here is we're starting to get better. And again, this is through 2012, so I can fast forward this for some quarters. And you see here, in 2012, on an annualized basis, we're around 7% of the deficit per GDP. We got all the way in the second quarter of this past year, of 2013, it was 4%. In the third quarter, a little bit worse than that. You think, well, what happened here? Well, simply in the second quarter, we had tremendous payments that were made to our Treasury from Fannie Mac and Freddie Mae. Tremendous payments. So that spiked this up a little bit. We did not have those payments in the third quarter. As you can see, if you just went from the year end here, it's still vast improvement. So we're heading in the right direction. The way to think about this, if we were on an annualized basis to have our economy grow 4% per year, that's not real growth, just nominal growth. So if we have, let's say, inflation of 2% and real GDP growth of 2%, that would be nominal GDP growth of 4%. If we had an annual deficit of 4%, then our ratio is going to stay exactly the same. Right now we're about 100% debt to GDP. If we grow our numerator by 4%, our denominator by 4%, we're still 100%. So as we get better than 4%, we should start seeing a decline in our debt to GDP. And I do believe that is the direction that we are heading in. So what's going on here? In 2013, tax receipts are way up. Again, the spike because of Fannie and Freddie, take that out. In the third quarter, you can see they're still substantially improved from where we were a year ago. Why? Well, a lot of that has to do with Social Security. Remember, we had the payroll holiday that there was 2% for everybody that we weren't paying into Social Security from our earnings. As of January 1, we were paying the full amount into Social Security, and surprisingly enough, tax receipts went up. So again, I question, I think politically it was a mistake to tamper with Social Security. I said that last year. I still believe it. I don't think we should look at Social Security as a tax, because it truly is for future income. But regardless, it happened, and you can see the result here as I took it off. In the meantime, spending, and now this is the end of 2010. Since 2010, spending has basically been flatlined at the federal level. So the good news is we have tax revenues going up, spending that is being held constant, and thus our deficit is being reduced from where we were. Employment. Good news in employment is the unemployment rate has dropped from 10% down to 6.7% as of the end of December. The good news stops there. Well, I shouldn't say. College graduates, I should point this out. There's a lot of talk about, college graduates, they can't find jobs. Maybe they can't find the perfect job, but they're finding jobs. College graduates' unemployment rate now is down to about 3%. Okay? We'd call that full employment. Now, it's not 2% that it was right before the recession hit. At 2%, we were probably beyond full employment at that point. But 3% is a pretty healthy number where we were back here in the early 2000s. So college graduates are finding jobs. Maybe those jobs are all waiting tables. I don't know, but they're working. Unskilled. So these are they have less than a high school diploma, high school dropouts, 25 years and over. This is what we would call our unskilled labor force. Our unskilled labor force unemployment is still double digits. And you think here, well, it looks a lot like the graph we just saw. Remember, that was 2% at the bottom, and it's at 3%. This is 5% at the bottom. We're still over 10%. So there's still a significant amount of slack in the labor pool. And this is what the Fed is looking at when, first I thought, well, if we got below 6.5% unemployment, it might be time to start raising interest rates. They totally backed off of that because of graphs like this. They say, there's still too much slack in the economy. Participation rate, and this is the other graph that has the Fed worried. We were at the peak of our participation rate over 67%. So what is the participation rate? We look at everybody 16 years and older, all the way up to 104. As a percent of that population, how many are in the labor force, meaning either working or unemployed but looking for work? So we peaked at 67. Today we're at 63. We should have expected some decline. Why should we have expected some decline? Well, we have that baby boom bubble now that is hitting retirement age. And so demographically, as they get into those years where they are retired, you would have expected this graph to start dropping. People think maybe 65, maybe 66% would be where it ought to be. Today, we're at 63%. So there's a significant amount of people that aren't working that ought to be in the labor force. So we delve a little deeper into this. These are only people 25 to 54 years old. So you have to ask yourself, who in that age group isn't working, or why aren't they working? They could have won the lottery one of two ways. Could have been born winning lottery, or they could have actually won the lottery. 84% was the peak here. Now, you say, why did we have this run up here? That's just women entering the labor force through the 60s, 70s, 80s. And then we pretty much peaked when we got into 1990, women being in the labor force. It sort of stabilized and stayed stabilized, even through here, even through the middle of the recession. We pretty much were around 83, 84%, and now we've dropped down to 81%. So why? I mean, and I don't have the answer to this question. Why aren't these people in the labor force? Because they ought to be. We should still be 83, 84%, because again, we're 25 to 54. If you're not working, you ought to be looking for a job. So that's something that the Fed really needs to understand, and our government needs to understand what is happening here. Interestingly enough, labor force participation rate 55 years and over. This has been steadily rising. So why? Why are people 55 and over? Why are more people working longer? And I think it's interesting to go back and say, well, why were they working back here in the 50s and 60s? And I think you have to go back and remember, when did Social Security start? When were people able to retire on full Social Security? 30 years after Social Security started, right? So we're, in the 60s, and we started to drop here. And then what else came along in the, mainly in the 50s, were corporate pension plans. Corporate pension plans became a big deal, and people were able to retire on Social Security and corporate pensions, and they didn't have to work past 65. And that's indeed what happened. We got down to 30% of those 55 and over were still working. So now we're having that reversal of what happens in demographics when you no longer have a pension to rely on. Yes, we have 401ks, but we know in our industry is far too many people spend their 401ks on other things than retirement income. It's a shame, but that is what is happening here. So I think this trend, although we seem to have stabilized at 40 over the years, is going to continue to move higher. The participation rate of men in the labor force has been in a long decline here, but as you can see, since the recession ended, has accelerated downwards. Whereas women seem to have topped out here at 60%, we're now at 57%. Not nearly as dramatic as a fall as we saw with men, and they're only really recently starting to leave. A little bit, that doesn't tell as much of a story there. Okay, now what do we have here? Participation rate with no disability, 16 to 64 years old. Again, your prime working years. This is a little volatile. Well, it's a survey. You're calling households. How many are disabled? So you don't have a smooth look at this, but you can see the trend. And the trend since 2010, or since the recession really ended, or maybe a year after, has been pretty stable. We had our peaks and valleys, but basically we're still in the same area, 82, 83%. However, participation rate with a disability, 16 to 64, what's happening here? We've gone from 35% in the last year, or in the last 6 months really, down to 31%. So what is going on? Well, for those that, like myself, who watch 60 Minutes religiously, there's an expose on this. And you can't help but see a graph like this and recognize that somebody somewhere is gaming the system. And that's exactly what is going on here. And that's what 60 Minutes is all about. People who used to have some sort of disability but were perfectly capable of working now have been able to collect full Social Security, disability Social Security, and no longer have to work. These are people whose unemployment insurance have run out, and they found a way to continue to get a government check. This is an issue, again, that our federal government needs, our Congress needs to deal with, although I think they're oblivious to it. I honestly do, because I hear no one talking about it. What does that mean? As I say here, 3 million people have left the workforce since 2011, disabled. Those who are claiming they're disabled anyway are out of the labor force. Okay, enough on employment. Manufacturing. We already know manufacturing activity picked up significantly in the second half. Again, here we are after the end of the second quarter. Manufacturing was basically flatlined. This red line is a line of demarcation between growth or contraction in the manufacturing industry. We got slightly below that line of demarcation, but we've had a huge acceleration in the second half of the year for manufacturing activity here. That's good news. Even better news is new orders, which actually started growing during the second quarter of 2013. It's a leading indicator to manufacturing activity, and it's well over 60 now, which is a very significant number for manufacturing activity, and we should expect in the next couple of quarters that manufacturing activity will continue to be strong. Utilization rates, so this is saying how much of our factories are we utilizing here. Once you get above 80%, that is a line where you say there has to be significant build-out of more factories and more manufacturing capacity. We're getting close to that. We're at 77.5. We bottomed here at 64% in the recession. We are at a post-recession high. If you look back here, we were only about 78% prior to the recession starting. And the 80% is a number that's been used for decades here. Because in our manufacturing that the amount of technology advancements that are happening, technological advancements happening, really that 80% very well could be much lower today because the factories are just becoming obsolete far quicker than they ever used to be. Housing. Again, the 50-year average about 1.5 million. What I wanted to point out here, these blue lines, recessions, every time we had a recession going all the way back, we came down to about 1 million. I know you can't read these numbers, which is not a problem, but that's right around 1 million units being built right here. And we always peaked right around 1 million, or troughed, excuse me, right around 1 million and came sharply back. Every time coming out of the recession, a sharp rebound. And by the way, rebound always went above the 1.5 million. So this time, when we fell down to 500, we have not had a sharp rebound. In fact, for the first 2 years here, we had no rebound at all. It just sort of flatlined here down at the trough. We're starting to finally come up, and that's why we are very optimistic on housing, is we know there's a significant amount of pent-up demand, and we're finally seeing that urge to go ahead and get your first home, get into your first apartment, whatever it may be. Also positive, vacancy rates. Even when I was here last year, vacancy rates were still quite high. We've really come back down to, we're at sort of the top end of the normal range. So we're getting to an area, and this is about, was just under 2% of units that are vacant in our society. And there's always going to be some vacancy, some transition that's occurring from one to another. We peaked here almost at 3%. High was 2.9. So we've come down a full 1%, or 1/3 of the vacancy has now been sopped up. This is the Housing Affordability Index. I always have to go through an explanation of this. This is the government's way. What they do is they take a look at what the average income, household income, can afford for whatever the price of the house is. So let's say the average household income is $75,000 and the average home out there is $150,000. All right, that would be 100%. If that's what an average house can afford average house can afford a mortgage of $150,000 or buy a home of $150,000. Now, what they do then, that'd be 100%. Oops, excuse me. They look then, what is the average income, household income, and what is the average house, and they have an affordability index. So if it's over 100%, then that's good news. If it's below 100, which it hasn't been for quite a while, but if it's below 100 or at 100, then you're getting into some frothy areas. We got all the way up here to over 200%. So the average household income could afford twice the amount of the average home that's out there. We're still here around 170%. So it's still houses are still very affordable out there in society. The housing bubble has been deflated here. This is the home ownership rate. We peaked a little over 69%. Remember, there was this thought that everybody should own their home. Well, we've sort of done away with that thinking here. We're back down to 65%, which is sort of generally in the area. This is 64 right here. So we're generally in the area we had been historically. And then housing supply, how many houses are out there on the market? We're back to normal levels. So it seems to me we had this huge housing bubble, and we've deflated that bubble. We're back to normal times. At normal times, we should have at least 1.5 million homes being built a year. Home builders are optimistic. This is just what it says, the Home Builder Optimism Index. We're back to some very good levels, so they're seeing the foot traffic in the new homes, so that's good news. Delinquencies have begun to lower, but we're still, obviously way up here. Delinquency normally for homes is around 2%, and we're still at 9% nationwide here. So it's still way too high, but it is moving in the right direction. So there have been some that are out there saying, uh-oh, housing is getting again into bubble territory. Why? Because prices over the last year are up about 15%. And that's where we're up here, 15% before the bubble burst. So the thought is, 15% is too fast, and we're going to have another bubble bursting. But if you look at it from an absolute level, where are home prices? We're still, this is 2014, go back here, we're 2004. Home prices are only nationwide at where they were in 2004. So, big no, we're not in a new housing bubble. We got a long way to go before you could ever even consider us being in a housing bubble here. Consumers. Household debt service ratio. This goes all the way back to 1984, mid-1980s. This is just what it's saying. How much of your income is going to pay down debt? Pay your credit card bills, your auto loans, your mortgage, and so forth. Nationally, we got all the way up to 13%. Today, we're at 10%. Why are we so much lower? Low interest rates. That's why. And it's had a tremendous impact, and it's what the Fed wanted. Back here before the recession, we just couldn't handle all that debt. Today we can. Today we have capacity to take on new debt. Delinquencies, this is for just consumer loans, so we know mortgages are high. Well, what we do know is that instead of paying necessarily their mortgages, what everybody's paying is their consumer debt, all-time lows at least as far as this history goes. Which is back again to the mid-1980s. Consumer credit is continuing to expand. So, if we kind of look at this trend here, we had this dip here right after the recession ended, when everybody was sort of holding on to their wallets. They're willing to spend again, and consumer credit is rising at about an annual rate of 6.5%. So, good, healthy rise. Auto sales. I'd throw this in for Rob McKinnon. We bottomed here at about 10 million cars, autos, and trucks. Cars and trucks being sold in the United States per year. We're up now to 16 million, and the thought is we're probably going to get to the 17, 18 million before the rebound is fully over. Again, a lot of pent-up demand that was created in this time frame. Consumer confidence. Now, I have two red circles here. And the reason for that is these are the peaks of consumer confidence going all the way back to the 1960s. This first peak happened in the late 60s. This peak happened in the late 90s. What these two have in common is that they came at the very end of secular bull markets. Bull markets that have been going on for 15 plus years. Everybody remembers, well, I don't know if everybody remembers, but in the late 1960s, the Dow Jones crossed 1,000 for the very first time. It didn't recross 1,000 until 1982, so in this area. And we all know that the market peaked in 1999, 2000, and then the Dow Jones didn't again get up to those levels until just about a year ago. So when you have these very high levels of consumer confidence, it's time to worry. It's not time to be excited. When everybody's excited, you should be worried. So where are we today? We're not in worry territory. It's actually, you see where consumer confidence bottoms, it's generally after recessions end. After they end is when consumers are most despondent. That's when you should be buying. That's why when we came here in 2009, I said this is a time to buy because everybody was despondent. Fed credit and money. So what are we looking at here? Well, first of all, commercial banks. One of the downsides to what happened in this past year is that commercial banks slowed down their credit expansion. So why did we, and I put we being, not that Chemung Canal did, but we being in this industry? Well, there are a couple reasons, but I think more than anything, it was because at the end of last year and beginning of the year, companies were nervous about what was going on because, again, we had the fiscal cliff that everybody was dealing with, and nobody really knew what was going to happen, and nobody really wanted to expand. What you'll note here is that this is only, well, you can't see that, but this is only for the third quarter. I fully expect the fourth quarter we're going to start seeing some rebound, because what we're seeing here now is expansion happening at corporations, plan expansion, and plans to expand in 2014 and out to 2015. So I do believe that we're going to start seeing this turn around very soon. So this is what everybody's worried about. This is the monetary base, which has just gone parabolic here in the last few years. So we went from monetary base of approximately $1 trillion to 3.7 trillion. So what is the monetary base? Well, the monetary base is going to be the cash that is out in society, checking accounts, so forth, plus the cash is on deposit with the Fed. Okay, and that's very important. That plus part is very important, because this all has occurred because the Fed has been out there buying bonds and putting cash out there in society, which is now on deposit with the Fed. Gets to the banks don't know what to do with it, they put it on deposit with the Fed. Well, what is very important about inflation is not so much the monetary base, but the growth of M2. This is the money stock. This is what is actually out there in society. You know, the money that is circulating, the money that is in checking accounts, saving accounts, and so forth. This has been growing at a very steady clip all the way back to 1995. It's been growing at a 6 to 7% rate. And by the way, I did this on a logarithmic scale, so this is a consistent rate scale. So every time you grow 10%, it's the same distance. So that's why you see, or every time you double. 2 to 4 is a very large amount, the same as 4 to 8. Well, 4 to 6 would be half the amount as it is from 2 to 4. So you can see as we've been growing, it's just been compounding at a 6 to 7% rate. Should you be worried about 6 to 7% rate? Well, the money stock ought to grow at about what you expect nominal GDP to grow. We should expect nominal GDP, that would be inflation plus real growth, of around 6%. So no, 6 to 7% is not an area to worry about. If we can have real GDP of 4%, inflation of 2%, which is the Fed's target, we get to 6%, which is nominal. This is really your inventory turns of money. How fast is it turning over in society? The reason why it's way down is because all the money that is being drawn out of society and put on account with the Fed. So the question we have to ask is, has the Fed done any good at all of doing the bond buying program, the quantitative easing? From a purely mathematical standpoint, no, it hasn't made a difference. We don't have M2 growing, right? It hasn't created any inflation. We know inflation is very low here. So why are they doing it? Well, it was purely for psychological reasons. If everybody here and everybody in America knows that the Fed is on our side to get things going, we're going to feel more confident and go out and spend money. And that's exactly what it did. And it served its purpose, and that is why now the Fed is beginning to taper. Because they recognize that we have now gotten to a point where the economy is self-sustaining. And as we're self-sustaining, they're going to start withdrawing the quantitative easing. But what they're not going to do is start raising interest rates anytime soon. Because that has much bigger impact on what's happening in our economy. It has had a big impact, as we saw those prior graphs, by getting consumer debt loads down and the amount that we're spending. And then our inflation rate, this is the Fed's favorite inflation, the personal consumption expenditure. We'll get a new number on Friday. We're at 1%. So, basically no inflation. As you can see, we go back here in time to the 1960s. That's where we were for the first half of the decade of the 1960s. We came down to it in 1998, got to 2%, now back to 1%. So the Fed has slack to continue to help the economy along, to be supportive of economic growth. They have a dual mandate, control inflation and full employment. Right now they're worried mostly about employment. So then the question is, long term, how long can this go on? How long can we have close to 0% interest rates in the short end? So I take it back to the 1930s. Now we know we had the Depression, but the Depression ended, in 1941 when we started the building up for the World War II. And from 1941 to 1948, we basically were at 0 or 0.5%. And we never really got above 2% or 2.5% until the late 1950s. So I'm not saying the Fed's going to stay at 0, but what I am saying is that the Fed can stay very low for a very long time. If we continue to have close to no inflation or under their Fed target of 2%, there's no reason that the Fed has to raise interest rates above 2%. And I think that's probably where we are for a significant period of time. Now, the next chart is going to scare everybody because you can't read any of that. But you can read 1877 and 1960. And you can see this black line. And underneath this black line is a blue line except for one period of time here, which is in the very early 1920s. Well, this black line is looking at the 10-year Treasury yields at 4%. So for these, 83 years, for 83 years, with the exception of a very short period of time, the 10-year Treasury was under 4%. All we remember is this period of time. And what I'm saying is, maybe this is what is normal, and this was abnormal. I tend to think that we probably are going to be in a period of time like we were from 1877 to 1960. I tend to believe that is far more likely scenario than this. Far more likely. Yes, the Fed has been involved with quantitative easing, but there's significant incentive for the Fed to keep interest rates low. Why? Well, they start raising interest rates dramatically. What happens to our deficit? All that money is going to be rolled over at higher interest rates. Is going to increase our deficit. The Fed does not want to be involved with that. Inflation is likely to remain low for an extended period of time. There just simply isn't reason for them to significantly increase interest rates. And thus, I do believe that we're going to see a 10-year Treasury note that has a top end of 4% for an extended period of time. I'm not saying next 83 years, but for an extended period of time. And by the way, this goes all the way back to 1790, and you think, well, why was it well above 4% for all that period of time? And remember, our nation was new. Nobody knew if this experiment in governance was going to actually work. So you had to issue debt at a higher yield than what was happening in parts of Europe where it was far lower. But after the Civil War, the experiment was pretty much over. We knew it was going to work and be long-lasting, and indeed, that's what happened here. By the way, this period of time here was immediately after World War I, when inflation started getting out of control, and the Fed quenched that inflation down by raising interest rates to 5%. We got 10-year up to 5% or almost up to 6%. Quickly, those numbers of inflation were extinguished, and we went back to having about 2% inflation. Okay, now the stock market. We all know we're up 30% last year. Again, S&P 500 weekly price, 1999. We hit it here in 2007. Didn't actually get above that. Well, we use this as proxy of Dow, and it's talking about Dow 1000, to just the middle part of last year. So we're now at all-time highs. Let's look at operating earnings per share. Here we were in 1999. S&P operating earnings were about $50 a share. We got up here to about $80 a share right before the recession hit. Went back to $50, and now we're up to $102. This is trailing 12 months. These are real operating earnings, trailing 12 months. The expectation for next year is around $110. Okay, so 8%, maybe a little bit more than that, depending on what happens here. But I think 8% is probably a good target for earnings growth. price to normalized earnings. Going back here again, 30 years, or 25 years, I think this is. We're pretty much around 15, 16 times earnings for a good period of time. Then we had the bull market, got us all the way up to 35. We took that back. So those that say there's no reason for the market to be this high, it's all Fed-induced, is just bogus, because those are real earnings. If those are real earnings, then we're trading on real earnings around 17 times earnings in a period of time when interest rates are at historical low levels. So I do not in any way subscribe to the theory that we're in a bubble for the stock market. I don't think there's any proof to that at all. Why was the market up 30% last year when earnings were only up about 8%? This is the equity risk premium. Going back here from 2000, in the 2000s, we had an equity risk premium which was at historical averages, around 3%. And what does that mean? Well, that's how much more anticipated return you should get than a risk-free rate of return. Okay, that's all it's talking. You're taking risk in the stock market. How much excess return should you get for taking that risk? About 3%. In the middle of the recession, we got all the way up here to 13%. All right. So when what was hitting the fan, right? In the middle of the recession, everybody was scared. Everybody got out of the market. Prices were very low in the stock market. It was a time to buy. As Sir John Templeton used to say, I like to buy when there's blood in the streets. There was blood in the streets here. So then we took some of that out of here, but then we had the European debt crisis, and we had this rising again because of what was going on in Europe. So here, and quite frankly, at the end of 2012, we were worried about the United States and the fiscal cliff and all that. So we were nervous here, and we were back into a secondary peak here of about 10% equity risk premium. Well, we've gone from 10% down to a current of 5%. So we cut in half the equity risk premium. We're still above, we're still above what would be considered normal, which would be between 3 and 4%, but not significantly above. And I think there are reasons to continue to be above that, given our debt situation. It is improving, but majority of the return happened because we drove the equity risk premium down to more historical levels. Now, this is just a look of stocks versus bonds, so I'm not going to go through a whole dissertation of what these charts mean. But basically, when the green line's above the blue line, it's time to buy bonds. When the blue line's above the green line, it's time to buy stocks. Okay? So if we look back here in 1999, green line was way above the blue line. You just should have been buying bonds. All right, we get back here. Obviously, we should have been buying stocks in 2007, and then again in 2011, 2012. Now, we brought that back in. We brought that back in, but still, stocks versus bonds, you want to be in stocks. So what to expect the next 12 months? Economic growth, we expect to be the fastest since 2006 at an annual rate of 4%. 10-year Treasury note will rise, but remain well below 4%. We think around 3.5%. I say above 3.5%, but right around 3.5% we think is where it's going. Housing starts will rise to 1.4 million, just below the long-term average. 3 million jobs be created. Unemployment rate falling to 6.2%. I do think the participation rate is going to rise, and I think it's going to rise because people are going to recognize that there are opportunities to make more money working than not working. That's ridiculous, but today there's many people out there who are still collecting a government check that could be working. S&P generates positive returns, but under 10%. So I said I think 8% earnings growth. I think we keep that equity risk premium slightly above historical averages. So that's where I get 8%. And I always end with a quote, and one of our favorite Elmirans, Mark Twain. Whenever you find yourself on the side of the majority, it's time to pause and reflect. All right. I open up for questions. I know some. I know there are questions out there. Come on. we got one more. Yeah, go ahead, Jan, first, and then we'll bring it over.
What do you think are some of the potential risks this year that could pop up and change some of your predictions?
Yeah, well, the market, as we all know, has been down for the last couple of weeks. And some of that has to do with some of the news coming out of the emerging markets. And certainly, emerging markets have some impact, although I think it's overblown right now. I think really, when we talk about emerging markets, we really only have to focus on China and India. And what's happening in some of these, I'll call them rogue nations like Venezuela, and to a lesser extent in Turkey, their economies are so small that they really have very little bearing on harming us. But what's happening in China and what's happening in India does have a big impact. China is, we continue to expect that they're going to come out of their doldrums, so to speak, but they seem to be getting further into it. The latest manufacturing data actually showed some contraction going on there, which is quite unusual in China. So I think focusing on emerging markets, particularly China, India, that could have some harmful impacts because we all know we're a global economy now, and most of our Fortune 500 companies have significant sales in that region of the world. I had to say, Jan, I believe the political risk is beyond us. It's behind us. Excuse me. I really do. I think we've learned our lesson, or at least Washington has learned the lesson about the infighting that goes on there, and we ought to continue to see improvement in the deficit in that end. So I would say emerging markets is the biggest known risk that's out there. Question here.
I had a question, but Jan already asked.
Okay. Mr. Bish, hold on, go ahead.
Do you think the big banks have finally cleared up the balance sheets?
Oh, well, yeah. I mean, their balance sheets are definitely in far better shape than they were a few years ago. So I would answer that question with yes. That being said, some of these fines that the federal government is imposing on them are still very significant and harms their capital.
There's no doubt about it. It harms their capital when it's beyond their reserves. And part of the reason why some of these large commercial banks are seemingly not lending is because their capital's been harmed. They have to rebuild their capital through earnings. So it's been a difficult time period here. But I do think we're pretty darn close to the end there.
And an improving economy is going to improve balance sheets at these banks. Bob.
Yeah, Tom, given the President's remarks last night pushing for a minimum wage increase significantly, I think I heard $10 an hour, if I'm mistaken here, as well as essentially an agenda of redistribution of some of the income. How does that affect some of your predictions? How much do you think that will affect this in 2020?
Yeah. We all like free markets, right? I mean, if we're economists, that's what we want. The fact of the matter is, currently earning minimum wage is a very small percentage of the population. Typically, I think it's something like 80% of those in minimum wage are teenagers working their first job, and generally on the job for less than 3 months. Because generally, if you're working at McDonald's, you get a raise. If you're any good, they'll give you a raise. So now, up to $10, and for just federal, I haven't looked at that data enough to know how many people are actually working for less than $10 an hour at some of these companies. I don't know if there is any data out there. I don't know if that's just make it sound good, but nobody at these companies that have federal contracts, or if anybody in these companies that have federal contracts are actually paying anybody that low. So I think it has very little bearing for what he's proposed. Now, more globally, if we were to raise some of these minimum wages, I mean, we've heard some cities imposing $15. I mean, that starts to obviously have a big impact and will not be helpful to propelling the economy forward. I don't think the proposal last night is going to make much of a difference. Is there a second part to your question?
No, I think really essentially
Oh, yeah, I won't touch that.
There was less specifics.
Right.
Do you have any specific sectors in the stock market that you are most optimistic about in the next 12 months?
Yes. When you have an economy that is starting to accelerate, you have to look at the manufacturing sectors. Okay, so I am very optimistic that the manufacturing sector will have a very good year. Also looking at some of the consumer durable companies, so we're looking at cars, autos, we're looking at housing, those type of stocks I think will continue to do quite well. I want to go back a little bit. In 2000, my second year doing this, 2010, I had a chart of 7 stocks. And I said, I think these are 7 stocks that we buy for the purpose of income replacement to bonds that have matured. Because we believe that at that point, the dividend yield was equivalent to bonds, and their dividends were going to continue to grow. And we showed a chart of what it would look like in 2015. And I brought it back a couple of times. I will bring that back next time. We'll show you what we said in 2010 and what actually happened. Those stocks were all in basically in the consumer area. There might have been 1 or 2 that were outside of that. But those are steady growing stocks. And I think it always makes sense to look at companies that have steady growth that are below average PE ratios. Today, many of those stocks are above average PE ratios. So many of those are 18 to 20. So we're talking about like the Coca-Colas of the world and Procters and Gamble's and so forth. They just got a little bit too expensive for me to like them today to purchase, but I love owning them. Okay, so it's a matter of what you buy at what point. But you find opportunities when they become available. So I hope I was elusive enough for you.
What do you think about energy sector? You mentioned about manufacturing, consumer durables and all that, but manufacturing picks up there. How about the energy sector? Would that be a promising area to look at?
Energy being in a commodity area is always difficult. Always difficult. We all know that we're going through an energy revolution here in the United States. Maybe not in New York State, but certainly in North Dakota, Texas, other areas of even California. Anyway, the problem with that is we've seen, as we're going through this revolution, prices, natural gas plummeted. And so companies have had a hard time earning a steady stream of income. What companies have done in the energy sector have done quite well, and I think will continue to do quite well, is in the servicing area. So those that like National Oil and Barco, that make the rigs or service the rigs that are out there, the Schlumbergers of the world, those types of companies I think will continue to do well because we certainly know that this is not going to end, this revolution. It's just going to continue to get better and better in the United States. We tend to stay away. Obviously we have a lot of assets in ExxonMobil and Chevron, the integrated oils, as just a holding place in portfolios. But along the edges, we've stayed away from a lot of the pure natural gas plays because of commodity price. It's very difficult for us to project and predict where that price is going. And if you can't do that, then you shouldn't own those companies. Anybody else? Thank you very much.